Welcome back to One More Stock channel. We are continuing our journey into the infrastructure that's really powering the future. Today, we're shifting focus a bit, maybe away from the super flashy world of AI and chips, and looking more at the essential foundation, energy storage. Our mission here, like always, is pretty simple. We take these complex stock stories, break down the analysis we find, like on the One More Money blog, and pull out the key insights we think you need to stay, well, truly informed. If you're serious about U.S. stock investment, definitely hit that subscribe button now. You don't want to miss these deep dives. Okay, so today we are doing a critical deep dive into Eos Energy Enterprises. That's ticker EOSE.
Right. And what's really fascinating here is seeing how the whole clean energy investment story is evolving. For ages, it felt like the focus was all on generation. You know, how much solar, how much wind can we get online? But the real bottleneck now, the critical piece missing for reliable renewables, it's storage. I mean, you could generate gigawatts of power when the sun's shining, but if you can't store it effectively for nighttime or, during a peak demand heat wave, the whole transition kind of stalls out.
That really is the core challenge, isn't it? Okay, so let's unpack EOC then. They're tackling this grid scale storage problem, this bottleneck. And this is key, they're doing it by deliberately not using the main chemistry everyone else chases, lithium ion. They're focusing purely on utility scale stuff, using like an alternative chemistry with zinc and manganese. So it's more of a critical industrial solution, not some consumer gadget story.
All right, let's get into the nuts and bolts. What does ES actually do? Pulling from that detailed analysis we looked at on the One More Money blog, ESE develops, manufactures, and markets these big utility-scale battery energy storage systems, BES, you often hear them called. And these are based on their own special zinc-based aqueous tech. They brand it as Zythia.
Yeah, and the key thing, the niche they're carving out, is duration. Their systems are built for what's called mid-duration storage. So think applications lasting anywhere from, say, 3 to 12 hours. It's not the super long duration stuff that runs for days, but it's exactly what's needed to solve some of the biggest grid headaches right now. Things like keeping the grid stable, easing congestion during peak times, and crucially, taking that solar power generated at noon and shifting it so it can be used in the evening. It positions them really nicely, sort of between the short burst stability solutions and those massive, longer-term hydrogen projects.
Okay, so the strategic appeal seems massive then. Storage really is becoming the secret sauce, like people say. If you can take intermittent solar and make it reliable, make it dispatchable, meaning the utility can call on it whenever, that kind of long-life, reliable utility-scale solution is incredibly valuable, especially, I imagine, for the more conservative utility customers they're targeting.
Exactly. And that connects directly to their manufacturing strategy, which is very strategic itself. ES manufacturers right here in the U.S., and they use materials that are abundant and mostly domestic zinc, manganese, water, graphite, stuff like that. This is so important because it cuts down their dependence on those really volatile, complex global supply chains, the ones controlling cobalt and nickel, for example. And this whole strategy lines up perfectly with major policy tailwinds, especially things like the domestic content rules and production tax credits you find in the Inflation Reduction Act, the IRA. That's basically validation and financial help all rolled into one.
They're definitely thinking big scale, too. I mean, the company is still in the early commercial stages, but the plan seems aggressive for scaling up. They're targeting something like 8 GWh annual production capacity by 2027 under their MAZE program, I think it's called.
Yeah, and just to give a sense of that scale, 1 GWh a gigawatt hour, that's enough power for maybe 100,000 average homes for an hour. Or it could potentially power a whole mid-sized city for several hours during a critical peak demand time. So getting to 8 GWh annually isn't just about building a bigger factory. It's aiming to fundamentally reshape grid capacity.
Okay, this is where it gets really interesting, I think, for anyone trying to figure out if EOS has long-term legs. Their competitive edge, it seems, isn't just about being a bit cheaper than lithium. It's this fundamental technology difference. So if they're not using lithium, what makes this zinc aqueous chemistry better for utilities? How does that create, a moat?
Well, the first thing, and arguably the most critical factor for utilities, is safety. EOS use a water-based aqueous electrolyte. And the key point here is that this makes the system inherently non-combustible. Lithium-ion batteries, as we know, if they get damaged or overheat, they can suffer from something called thermal runaway, which leads to these massive, intense, often toxic fires that are just incredibly hard to put out.
Right. So non-combustible. That sounds like a huge liability win for those conservative customers you mentioned. Can you maybe paint a clearer picture, like why are lithium fires such a specific nightmare when you're talking grid scale?
Oh, absolutely. Imagine a huge shipping container packed full of lithium batteries, maybe sitting near a suburban substation. If that thing catches fire, it's not like a car fire. It's way worse. It can release hazardous gases, you need specialized emergency crews, and these things can sometimes burn for days. So for a utility manager whose top priorities are reliability and minimizing risk, getting rid of that thermal runaway danger, that's almost priceless, especially now as regulations around battery safety are only getting tighter.
Okay, safety is huge, but the analysis we read also highlighted longevity. The claim is, what, 6,000 plus cycles, a 20-plus year lifespan, even in harsh conditions. But how much, real-world deployment data do they actually have to back up a 20-year claim, given it's still a relatively new industrial tech?
That's a completely fair and fundamental question. Any serious investor has to ask that. And while ES has definitely moved past pilot projects into real commercial deployments, that 20-year claim, it's still largely based on their internal testing, accelerated life cycle assessments, modeling. However, the chemistry itself using stable zinc and water does lend some credibility to the idea. It should, in theory, avoid the kind of degradation issues you see with lithium, especially in harsh environments or with frequent cycling. But you're right, monitoring their actual real-world performance validation over the next, say, 3 to 5 years, that's absolutely critical.
And we shouldn't forget the materials advantage we touched on earlier.
It's exactly right. Those abundant materials, the zinc and manganese, give them sort of a double strategic win. First, cost stability. They're much less exposed to the crazy price swings we see in global battery metals like cobalt and nickel. Second, it's political security. Using stuff they can get domestically reinforces their ability to tap into that policy support like the IRA. And it helps insulate them from geopolitical risks, tied to supply chains running through China or parts of Africa. It's basically a supply chain moat.
And the final layer of stickiness, maybe, is the whole system approach. They're not just selling the battery cells themselves, right?
Correct. EOS delivers a complete integrated system. You get the battery modules, the containerized solution, the controls, the power electronics, the whole package. They call them near-plug solutions. And this really streamlines things for utility customers. Instead of juggling different component suppliers, a utility buys EOS and gets more standardized, faster deployment. That's a big competitive plus. And this seems to be resonating because, as you mentioned, EOS talks about moving beyond just R&D into serious real-world stuff. They report this massive commercial pipeline, something like $18.8 billion, representing 77 GWh. Huge numbers.
Okay, that massive pipeline definitely shows the market demand is there. But the real question for investors is always, how do you pay for building out 77 GWh of manufacturing capacity? Which brings us right into the financials and, well, the massive risks involved too. Let's quickly review the Q2 2025 highlights that were in our analysis because there are some truly explosive growth numbers in there.
Yeah, we're seeing classic hypergrowth startup figures. Revenue for Q2 2025, $15.2 million. Which is up 46% just from the previous quarter, and in some ways like a staggering 17-fold jump year over year. Shipments were way up too, 122% quarter over quarter, and they even reaffirmed their really aggressive full-year 2025 revenue guidance between $150 and $190 million. The market's noticed for sure. The stock's shown really strong momentum lately. YTD returns reportedly over 200%.
And they also got that critical government backing, which acts as both funding and kind of a stamp of approval. They received a $22.7 million loan advance from the U.S. Department of Energy's Loan Programs Office, the LPO. That's part of a bigger, $303.5 million loan guarantee. Getting that DOE money tells the market, look, this tech has passed some serious technical and financial checks.
Right. But now we absolutely have to pivot and bring in the balance. We have to talk about the risks, especially for any risk-tolerant investor listening, because this is where it gets really complex. Scaling up a capital-heavy infrastructure tech like this, it's incredibly expensive. So despite that impressive revenue growth, the company still posted a large net loss in Q2 2025, around $222.9 million. Now, okay, a lot of that loss was due to non-cash adjustments. But the critical takeaway, cash burn is significant. And overall, their gross margins are still negative. They're selling product, yes, but still losing money on each unit sold, for now.
That big loss in negative gross margin, that's kind of the nature of the beast, right? A bit like how Tesla had to just hemorrhage cash for years building gigafactories before they hit scale efficiency.
Precisely. That's a good analogy. We call it the execution risk tied to the cost curve. And the cycle from signing a deal in the pipeline to getting a firm contract, to actually building the thing and then finally recognizing the revenue. It's long, often 18 to 24 months. Any delays in that long cycle can really strain their working capital and push costs up. And because EOS isn't profitable yet and needs cash to fund this super fast growth, they recently did a large concurrent offering selling both stock and convertible senior notes.
Okay, let's pause there. For our listeners maybe not deep in finance, what does that convertible senior notes offering really mean for a regular shareholder?
It basically means pressure from potential dilution down the road. Convertible notes are essentially debt that can be swapped for stock later on, often at a discount. So while these notes give EOS cash today to build factories, if the stock price goes up significantly later, the note holders will likely convert their debt into shares. That increases the total number of shares out there, which in turn lowers the ownership percentage and the earnings per share for everyone who held the original stock. Look, it's a necessary tool for raising capital at this stage, but it really highlights that ongoing need to fund growth and the dilution risk that comes with it.
Right. So given this intense race scale up before the cash runs out, what are the absolute key financial metrics we need to watch to see if they're actually winning this race?
Okay, I'd focus intensely on three main things. First, keep watching revenue growth, obviously, but specifically, how quickly are they turning that massive $18.8 billion pipeline into actual recognized revenue? Second, and this is critical, gross margin improvement. They have to show that their cost per kilowatt hour is dropping significantly as they ramp up production. If that cost curve doesn't bend downward sharply, the whole investment thesis starts to break down. And third, closely watch their backlog and pipeline conversion rates. Specifically, how are they tracking against their own manufacturing capacity targets, like hitting that 2 GWh goal by the end of 2025 they talked about? So to sort of pull this all together, EOS offers what looks like a really compelling and potentially asymmetric investment idea. It's sitting right at the intersection of, well, three big forces. That strong secular shift towards mid and long-duration grid storage, a unique differentiated technology, especially around safety and materials, and clear policy tailwinds like the IRA and LPO support favoring domestic manufacturing.
However, the analysis from the One More Money blog was crystal clear about who this kind of investment is for. It's definitely not for everyone. This is really for investors with a long-term horizon. We're talking 3, 5, maybe even more years out. You have to be inherently risk tolerant, understand that there will be volatility. And you need to be willing to closely track those execution milestones, scaling up manufacturing, improving costs, rather than just focusing on, short-term profits or quarterly bumps.
Absolutely spot on. The market is only going to reward them if they actually hit those specific critical milestones. We need to see them achieve those manufacturing capacity targets, hitting that 2 GWh annualized production by end of 2025 is a big one. And we need to see them consistently show real, tangible improvements in their cost of storage, that crucial USD per kilowatt hour figure, and get those gross margins moving towards positive territory. Scaling effectively and driving down costs. That's the single most important game they're playing right now.
It really feels like EOS is standing right at that crossroads of huge megatrends, clean energy, grid modernization, domestic infrastructure. If they can execute, if they pull it off, the potential return from delivering a safer U.S.-sourced alternative to lithium could be enormous. Asymmetric, like you said.
But but we have to keep saying it. The path to profitability is long. It's very capital intensive. And it's absolutely full of significant execution hurdles. The potential rewards are high, yes, but so is the potential for bumps along the way. Volatility is almost guaranteed.
That might be the perfect final thought for everyone listening to chew on. If EOS can genuinely make zinc storage work reliably and at scale, they don't just capture a niche market. They could fundamentally help secure the U.S. grid with domestically produced, non-flammable infrastructure. Huge implications.
Quickly. Okay, just the mandatory bit. This analysis is written for informational purposes only and does not constitute investment advice. Thank you so much for watching. We really, really appreciate you tuning in and engaging with this. If you are interested in U.S. stock investment and you want more deep dives like this one sent your way, please make sure you subscribe to the OneMoreStock channel. That way you won't miss any of our latest videos.
Yeah, definitely. And please do like this video and drop a comment below. Let us know what you think about EOS, about grid storage, about the whole topic. We genuinely love hearing your thoughts. We'll catch you on the next stock analysis.